Do you agree with that interpretation of the recent rout we've seen in the bond market? Is that what the market is signalling?
Yeah, I don't see very much inflation pressure for the U.S. economy. It's true that the U.S. is growing pretty rapidly right now, but that's likely to slow down in 2019. I think bond market overall knows that and has that in mind.
James, I want to throw up this chart in our GTV library looking at this almost kind of existential conundrum of why wages are not moving in the relationship that we expect them to. This is in our GTV library. This is really painting the picture that despite the difficulty in finding quality labour in the market for small businesses, we know this is an issue, that the Fed wage growth tracker for Atlanta continues to look pretty sluggish. Chairman Powell said last week that you could now call the Phillips curve the Phillips line, suggesting that wage labour market relationship has essentially flattened out. Do you think it's broken down? Is that something that you would see as a fair characterization?
Yeah, that's something I've been emphasizing, is that the Phillips curve is an empirical relationship, and that empirical relationship has not been very reliable in the last 20 years compared to the earlier parts of the post-war era in the U.S. So I don't think you can take as much of a signal directly from low unemployment that you might have in the past. So these wages are about 2.9% year over year on the employment cost index, which is the Fed's favorite index on this issue. And 2.9% makes a lot of sense if inflation's 2% and labor productivity has been about 1%. So it seems like wage growth is about where it should be, given productivity trends in the U.S. economy.
Given that we're now seeing yields surging, should we be less concerned about the yield curve inverting and what that would mean?
Yeah, I've been talking a lot about the yield curve. Obviously steepened some last week. I think that's probably welcome from my perspective. It means less chance of inversion near term here. I do think that a healthy 10-year, 2-year split would be something like 70 basis points. We're nowhere close to that today. So you would actually like to see a somewhat steeper yield curve to be healthy.
How much of the yield surge is about the Fed letting billions of dollars of its bond portfolio just run off?
Yeah, it's a great issue. I don't think that that's a big part of the story that's been going on in the background. The Fed's balance sheet has been shrinking. It's an important part of our policy, but I think that's a background story today. I think that you also have QE in foreign economies that hasn't let up yet, so you still got the BOJ and the ECB and others around the world. But I don't think it's a big part of the story now compared to what it was 3 or 4 years ago.
You know, the last time we spoke, of course, we spoke about the trade war, and you'd said something to the effect that, you know, hopefully part of this is just a negotiating tactic. We don't see much of a circuit breaker between Beijing and Washington at this point. I'm curious, as a policymaker, do you look at this and have to think at some point you will need to adjust policy for inflation, the inflationary effect of tariffs, and then potentially longer-term stagflationary effect, or do you think the effect is going to be so gradual that it's not going to be significant?
I agree that we're not seeing very much progress on China-U.S. trade relations right now, but I do think that the announcement of NAFTA 2.0 is a very positive development, because it shows that if you carry on some negotiations, you can modernize trade relationships and get the deal done and hopefully get trade, you know, off the front page and back to normal. I would see something like that being possible with China and the U.S., but right now both sides are digging in, it appears.
If the trade war continues, and actually even if it doesn't, and the Fed continues along its current trajectory, what do you assign to the chance of the U.S. cycle entering a recession over the next 2 years?
I don't think recession probability models are saying that there's any higher chance of recession right now than there is in kind of, you know, unconditionally or during any normal time. But we are late in the cycle. I do think you have to be aware that recessions do occur, and so I think we have to be careful on that side and take that risk into account. But I just don't see anything on the horizon right now. Obviously, the U.S. economy is growing quite rapidly. It looks like we'll hit 3% for 2018. And then as the effects of some of the fiscal stimulus wear off and the economy naturally slows down in 2019 and 2020, it'll be a slower growth economy, probably with less jobs growth as well.
If this trade war with China puts a lid on U.S. economic growth, could this be a sort of blessing in disguise if it allows the Fed to do its job, continue with its plan gradually without having to worry about an overheating economy?
Yeah, well, I don't know if a trade war is ever a good idea, but to the extent that it's a negotiation situation that might come out to fruition in the end, as the NAFTA thing did, I think there is some reason for hope, and hopefully we can get these issues hammered out and get to a set of trade rules that make sense for both China and the U.S., and from there, then we can proceed.
So how much is the Fed really factoring in the potential effects of tariffs and the trade war, and should the Fed be factoring it in more?
You know, if you do macroeconomic models on trade effects, you tend to get small effects at the macroeconomic level. That's because these tariffs are on particular goods and particular industries. And while the billions that are cited sound like big numbers, they're not big numbers compared to the trillions, which is the size of the overall economy. So you tend to, if you feed those effects directly through models, you tend to get small effects. Now, if it was a blanket tariff on all goods coming in and into China, or all goods coming into the U.S., and you did something about third country effects, that could have a huge effect on the economy, and that is a concern. I don't think we're there yet. And again, I think there's plenty of prospect for negotiation going forward.
You know, Fed Chair Powell also mentioned that he thinks that rates are still a fair while away from reaching neutral, and that they're still accommodative at this point. I know that your view is probably somewhat different. What happens, though, when we get to neutral?
Well, my own view is that we're close to neutral today. When I look at inflation expectations from the TIPS market, it looks like they're about at 2% on a personal consumption expenditures inflation basis, or somewhat below 2% even over the next 5 years and the next 10 years. So as of right now, the market doesn't really think we're going to hit our inflation target on our preferred measure over that kind of time horizon. So that suggests to me that we've got about the right level of rates today, and then we should react to incoming data, see if it surprises to the upside or the downside. We haven't had a long run here during 2017 and 2018 of pretty good news on the U.S. economy. It may not always be that way. One day we may get some bad news and have to adjust the other way. So I think we have to be prepared that the news isn't always going to be good.
And those good news seem to have helped FOMC members to become a bit more in line when it comes to their dots expectations. Of course, for this year, the consensus seems to be about 4 rate hikes this year. But the problem is what happens when it comes to 2019, and dots go on the Bloomberg showing you exactly how divided Fed members seem to be. What are your expectations?
Yeah, I think I guess my main point is, because I'm the low dots in this picture here, my main point is that we're at a good level of rates today for our environment today. We don't have to be projecting planned rate hikes at this point. We can react to data as it comes in. We can feel our way and see where we want to go. But I don't think it's a situation where we need to get a lot higher with the policy rate in order to contain inflation, because there just isn't that much inflation pressure in the U.S. economy. Phillips curve effects are very weak today compared to what they were in the past.